Hi everyone, welcome to another video by Stock Trades. My name is Matt, and today we are going to look at an industry that we are quite excited about, that of telehealth and virtual medicine. It's an industry that is seeing exponential growth, and today we're going to look at 3 options for investors on how they can take advantage of this rising industry. Let's look at the industry in general. For years, physicians have been advocating for online billing codes. Unfortunately, it's taken a pandemic for the governments to finally act. For example, in Ontario, the government's pushed through virtual billing codes in a matter of weeks. This is good news. This means that the technology sector has been forced to act. Sometimes a crisis breeds innovation, and now physicians across the country are learning how to interact with patients virtually. This means that the adoption of virtual medicine platforms and softwares is going to accelerate. Not only is it going to accelerate because of the first wave of the pandemic, but it is also here to stay. The reality is virtual medicine can do a number of things. It can actually improve access to care for patients in underserved areas, for patients in rural and remote locations that may not have access to a physician on a daily basis. Likewise, it'll also help the physicians, especially those in primary care settings, who have significant high overhead costs for their family practice. Moving to a virtual model will enable these physicians to reduce the overhead costs of their practices. So how do investors take advantage? In my opinion, there are 3 companies who have become leaders in this area. And of note, before we get into these, I fully want to disclose that I am an owner of all 3 of these companies. I believe that it's good to spread ourselves out. We don't know who will emerge as the ultimate winner, but we do know that there is room for multiple players in this industry. So with that in mind, let's look at the first pick, which is Telus. This one might surprise investors. Telus is largely known as a telecommunications company. Not surprisingly, it is one of the big 3 and has a dominant market share, and as such, it's valued accordingly. However, what doesn't get enough credit is the company's health business. It entered into this area back in 2008 and has since invested approximately $3.2 billion into its health subsidiary. The company has several different segments within the health subsidiary, one of which is Babylon, which is a platform which connects patients and doctors virtually. It also has Akira, which it recently purchased, and is a virtual care offering through insurance providers. Both of these platforms have seen significant growth during the pandemic. Babylon usage is up tenfold, and subscriptions to the Akira platform are up by approximately 80%. One of the reasons why Telus doesn't get enough credit for its health subsidiary is because of the lack of disclosure. All we know is that the company generates approximately $800 million in revenue, quite a significant number in the health segment. However, it doesn't give any details beyond that. This makes it very difficult to value. There is a light at the end of the tunnel. Telus recently announced that it is spinning out its international subsidiary, and there are talks that the company may eventually spin out its health subsidiary. This would probably unlock value and be a boon for shareholders. There's no doubt that the health platform is growing. However, without proper disclosure, Telus shareholders won't be able to unlock that benefit. That being said, in my opinion, it is still one of the leaders, and investors would do well to invest in Telus, and it is also what sets them apart from some of their competitors such as Rogers and BCE. Next on the list, let's talk about WELL Health Technologies. I first discovered WELL Health Technologies approximately a year and a half ago. At the time, it was trading on the TSX Venture. What attracted me to the company was the fact that it was growing at a fairly significant pace, at approximately 50% clip. It was doing so by acquiring medical clinics, and it was also a leading provider of Oscar, which is one of the best EMR platforms in the country. Now, it has since graduated to the TSX index, and it is the 3rd largest EMR provider in Canada. WELL has been one of the best performing stocks on the TSX index. In 2020, the company's stock price has doubled, and it has been successful in large part thanks to its aggressive acquisition profile. It is focused on acquiring primary health clinics, Oscar service providers, and other digital health companies. As an example, it didn't actually enter into the virtual care space until it made an acquisition earlier this year. Not surprisingly, Virtual Clinic Plus is seeing rapid adoption. This is in large part due to the fact that it is fully integrated with Oscar EMR platform. This means that it has access to 1,900 primary care clinics 10,000 practitioners, and over 15 million patients. Investors might be wondering if they've missed out. The company has, after all, doubled in 2020. I would say there's still lots of opportunity for growth. The company is only trading at approximately 8 times forward sales and is expected to grow revenues by 50% in 2020 and an additional 75% in 2021. And this may even be on the low side. The rapid adoption of all these virtual care platforms is leading to these companies beating estimates. So I wouldn't be surprised if upwards revisions are made over the next few months. All in all, WELL has a very strong history and a strong management team. It has a history of executing, and there is no reason to believe that WELL won't become one of the leading digital healthcare providers in the country. Speaking of leading digital healthcare providers, let's talk about CloudMD. What I like about CloudMD is that it is focused on digitizing the end-to-end solutions of healthcare delivery. Its software as a service platform can deliver the wide gamut of services. This makes it unique. Likewise, it is targeting not only medical clinics, but pharmacies and allied health professionals, such as mental health counselors, if you will. So it really has a large target market, and its SaaS platform, CloudMD, can service a number of different areas. This is a company that is expected to grow at an exponential pace. Take a look at this chart. As you can see, revenue is supposed to jump from approximately 11 million in 2019 to 57 million by 2022. This is equal to a compound annual growth rate of 70%. Not many companies can lay claim to this type of growth. Likewise, EBITDA is also supposed to grow at a pretty significant clip, from approximately 500,000 in 2019 to 19 million in 2022. This will be driven by an increase in gross margins from approximately 12% in 2019 to 36% in 2022. Analysts also have faith in the company. They have a one-year price target of $1.50 per share, which implies more than 100% upside from today's prices. As you can see in this Y chart, stock has done quite well over the past year. It's up 80% despite a little mini downtrend. So why the downtrend? Likely because the company has issued shares, a normal process for those companies in high growth. It'll allow them to accelerate their growth through acquisitions. As the markets digest new shares, typically this results in downward pressure on the share price. It won't last long. Assuming the company can meet targets, and at this point there's no reason to believe they can't, it is trading at only 2.6 times forward sales. In comparison, WELL is trading at 8 times forward sales. For a company growing at a 70% annual clip, this is cheap. In my opinion, the markets are significantly discounting DOC's growth potential, and it is only a matter of time before the share price catches up with expected growth rates. A word of caution: before you jump in to invest in a stock like DOC, you must understand your own risk tolerance. This is not for the defensive investor. It will be subject to wild swings and will be highly volatile. In my opinion, this stock is only for those with an aggressive risk profile and those who are comfortable with taking on that risk. And with that, we're at the end of our video. But before you go, we are doing something a little unique today. If you comment and let us know what your favorite telehealth or virtual care stock is, could be US, could be Canada, let us know what your favorite is, and you'll be entered into a random draw to receive a detailed stock report by Stock Trades on a company of your choice. You can only win if you comment, so please do so. So with that, please like our video, subscribe to our channel for more great Canadian content. Until next time.